Welcome to the deep dive. What a week, huh? Really significant shifts across global markets. We've got policy decisions from Washington making waves everywhere and, some pretty groundbreaking stuff in the digital economy.
Absolutely. No shortage of things to track. A lot of moving parts.
For sure. So today we're going to dig into a whole stack of fresh sources. We've got expert commentary, market analysis, key economic reports coming out of London, other financial hubs.
Yeah, good mix.
Our mission, like always, is to try and cut through some of that noise, pull out the really important insights, and help you understand the surprising facts, the ripple effects, how these complex stories connect. Should be some aha moments, hopefully.
Let's get into it.
Okay, let's unpack this. So with all that market flux, where else to start but the Fed? The Federal Reserve.
Yeah.
They're so influential. And wow, one Fed governor really made headlines this week.
Yeah, Christopher Waller.
Exactly. We have to talk about him. He made a pretty bold call. He's pushing for an immediate 25 basis point interest rate cut, like this month, July 2025.
It is bold. And what's really striking is the language he used. He described the job market as on the edge, even flashing red.
Flashing red. That's strong.
It's extreme language for a Fed governor, especially in a public statement. And his reasoning, well, it comes down to how he looks at the jobs data, the non-farm payrolls report.
Right, the NFP.
He basically adjusts it.
Yeah.
He takes out the government job additions, maybe 70,000 or so, he estimates. And then he also anticipates the BLS revisions, the updates they make later.
Which can be significant.
They often are, yeah. Maybe another 80,000 a month downward, potentially. So when he does that math, he argues that private payrolls are actually running around zero, or basically in slight contraction.
Wow. So slight contraction, that's the basis for his call for an immediate cut, a much weaker picture than the headlines.
That's his core argument, yeah.
But okay, that feels like a really strong stance, especially when, we just got jobless claims numbers declining for the fifth straight week.
Yeah.
Lowest since April, lowest in 3 years even. So how do you reconcile those two things from someone at Waller's level?
Well, that's the tension, isn't it?
Yeah.
And the market reaction, frankly, has been quite critical of Waller's take.
Yeah, I saw some of that. Ridiculous, annoying.
Exactly. And some are even suggesting it's a kind of late pitch for him to maybe become the next Fed governor, kicking Powell while he's down, so to speak. The politics angle.
It's hard to ignore. Now, he has been calling for cuts since April, but this latest statement, the language is definitely stronger, much stronger.
And this political dimension, it's broader than just Waller, right? I saw Larry Summers warning about this.
Yes. Summers warned that if the president puts direct pressure on Chair Powell, it could actually backfire. It might ironically drive inflation expectations higher.
The opposite effect.
Precisely. And from an expert perspective, any hint that Jay Powell might be pushed out would be a real shock to the market. It'd be seen as, potential interference from the White House, which markets hate.
They absolutely do. You'd likely see risk assets sell off pretty quickly because Fed independence is so valued. Now, Waller, for his part, insists his view isn't political.
He says he's just reading the data.
Right. He points out he was actually early in predicting inflation would come down. And he argues that keeping rates this high now means real interest rates are becoming overly tight for where the economy actually is.
Okay, this is where it gets really interesting, I think, because it helps explain why we see these conflicting data points, this idea of a K-shaped recovery.
Exactly. It's a really insightful concept here. It's not just about income anymore.
How so?
Well, you've got these pockets of the economy with a lot of cash, and for them, high interest rates. They're actually benefiting. They get better returns on savings. Their assets might still be appreciating.
Okay.
But then there's the other leg of the K. People and businesses who need to borrow. Real estate, small businesses, lower income folks may be carrying more debt. They're really struggling.
Because borrowing costs are so much higher, significantly higher. So you have these almost contradictory pressures. It makes the Fed's job incredibly complex. It's not a simple cut or hike decision anymore.
Yeah, that really paints a picture. And it makes the whole discussion about future rates and even Fed leadership much more intense.
Absolutely. And look, some people do see Waller as the intellectual mind behind the recent cycle, a serious contender down the line.
But not everyone's convinced a cut is needed right now.
Definitely not. You have strategists like at BNP Paribas who haven't expected any cuts in 2025 for a while now, since late last year, actually.
Why is that?
They point to the still tight U.S. labor market overall, despite Waller's adjustments, and the risk of second-round effects on inflation, where higher prices lead to higher wages, which push prices up again, that cycle.
Right, the wage price spiral concern. Okay, so shifting gears a bit from domestic policy, let's look globally. Trade wars, supply chains, seems like it's getting more complicated than just tariffs.
Yeah, definitely. The U.S. just announced these huge anti-dumping duties on graphite imports from China, 93.5%. 93.5%. Wow. And graphite is key for EV batteries, right?
A key ingredient, yes. So, as the source said, horrible news if you are Tesla or any EV maker relying on that supply chain.
It makes you wonder, is this really just about China? Or is there an EV angle, maybe even targeting specific figures like Musk?
It's complex, and what's fascinating are the mixed signals around Trump's position. On one hand, these new duties. On the other, reports he's actually softening his stance behind the scenes on China, on chip restrictions.
Softening behind the scenes while imposing massive tariffs publicly. How does that work?
Well, the market seems split. You have short-term traders reacting to the headlines, the tariffs. Then you have others taking a longer-term picture, believing Trump's ultimate goal is just to get a very good deal.
A negotiating tactic, maybe?
Could be. And, maybe surprisingly, some analysts even think China could be one of the big winners from all this tariff pressure in the long run.
How so? Because it forces them to innovate domestically.
Exactly. It accelerates their push for self-sufficiency, particularly in strategic areas like chips.
But these tensions, they have real corporate consequences too, right? I saw something about Wells Fargo.
Yes, reports that Wells Fargo was effectively stopped from exiting the country, facing major hurdles trying to wind down certain operations. Travel halted, trade finance impacted. It shows the friction isn't just theoretical.
Yeah. And all this uncertainty, it must be weighing on global growth.
It is. The OECD, for instance, they've further downgraded their global growth forecasts again. They specifically cite increasing trade restrictions and also tightening financial conditions globally as hitting confidence and investment.
Which brings us to things like the G20, the G7 meetings. Are they making any progress on these trade issues?
Well, there's clear disagreement, that's for sure, on how global trade should work. The OECD keeps pushing for dialogue, for cooperation, trying to make the system fair and work better, but still keep markets open.
A tough balance. What about that global minimum tax initiative? Any updates?
Yeah, it's moving forward. Legislation passed in 67 countries now. And the G7 is actively working on how to make it compatible with the U.S. system, the side-by-side arrangement idea.
To avoid double taxation.
Exactly, to prevent companies getting hit twice on the same income, which would be an unnecessary double-up. Germany apparently is a big backer of getting this coordination right.
Okay, and I have to ask about this quote I saw. It was pretty memorable, explaining why supply chains aren't just snapping back to the U.S. despite tariffs.
That's the spatula quote.
Yes. Tell us about that.
It's great, isn't it? Basically, a source said Chinese manufacturers are not rushing to shift production into the U.S. Why? Because, quote, Americans don't want to make spatulas, they want to eat hamburgers.
Chuckles slightly. Okay, a bit blunt, but it makes a point.
It really does. It highlights the practical realities, the differences in labor markets, costs, what industries are actually feasible to reshore. It's not as simple as just wanting it to happen.
Makes sense. Okay, from manufacturing spatulas, let's pivot to something much more digital. The Fintech revolution and crypto going mainstream. Big news from Congress.
Huge news, actually. A bipartisan bill passed regulating stablecoins. This is being seen widely as another win for crypto.
And potentially threatening to banks.
Yeah, threatening traditional deposits is how one source put it. Because stablecoins offer a way to hold and move dollar equivalents outside the traditional banking system.
And there's a political endorsement angle here too, isn't there?
Very explicit. Reports of Donald Trump Jr. being involved with a crypto treasury company, and Trump himself apparently getting ready to open up the U.S. retirement market, things like 401k to crypto investment.
Wow.
So the administration seems to be enthusiastically endorsing crypto on a personal level and an institutional level.
This must be exactly what Jamie Dimon, the JP Morgan CEO, has been warning about for years. The threat from fintech.
Absolutely. This stablecoin bill, could not be more bringing crypto into the mainstream. It directly addresses his long-standing concerns about capital moving away from banks.
And the scale here is just Mind-blowing. I saw a stat comparing stablecoin volumes to Visa and Mastercard.
Yeah, this is a real aha moment. The combined transaction volumes of major stablecoins like Tether and Circle's USDC are reportedly more than Visa and Mastercard combined.
More than Visa and Mastercard combined.
Combined, let that sink in. We're talking about digital dollars moving on blockchains at a scale that now surpasses the two biggest traditional payment networks.
That's staggering. Are there real-world examples of how this is being used?
Yes, there was a great anecdote.
Yeah.
The treasurer of a major global company is experimenting with stablecoins. Why? To move money across 180 different countries.
Okay.
And crucially, doing it instantly, 247, outside traditional banking hours and correspondent banking systems. That's the key. It bypasses the old rails.
Which is a direct challenge to the bank's cash management business.
Exactly. That's the problem for Jamie Dimon right there. Cash management, cross-border payments. That's core banking territory now being encroached upon.
So from a private equity or investment perspective, how are people looking at this space?
Well, the view from some PE sources is that people generally underestimate how meaningful and transformative the whole crypto world is going to be.
They see big potential.
Huge. Firms like Apis Partners, for instance, they're not just betting on Bitcoin's price. They're picking winners by investing in the underlying infrastructure. Mid-market companies with proven market fit, high growth like 25% plus.
What kind of companies?
Things enabling crypto payments, crypto infrastructure, and especially this area called embedded finance.
Embedded finance, what's that?
It's integrating financial services, payments, lending, insurance directly into non-financial apps or platforms. Think buy now, pay later inside a shopping app, but much broader.
Okay.
And that market, embedded finance, is projected to grow to something like $7 trillion in the next 10 years, doubling its already massive size today. Crypto and blockchain are seen as key enablers for that growth.
7 trillion. Wow. Okay, let's broaden out again, do a quick tour of some other global economic hotspots making waves. Europe and Russia.
Right. The EU just rolled out its 18th round of sanctions on Russia. Key measures include a lower oil price cap.
How does that work?
It's fixed twice a year, aims to be roughly $15 below the prevailing market rate, trying to crimp Russia's revenue while keeping oil flowing. They also put restrictions on a specific Russian-owned oil refinery located in India.
And the impact on oil prices?
Well, Brent crude did cross $70 a barrel, partly on this news. It feeds into that whole global inflation story we keep watching.
Definitely. What about Japan? Elections coming up.
Yes, the upper house elections.
Yeah.
And they actually have global significance if the outcome is bad for Japanese government bonds, JGBs.
What happens then?
You could see a steepening of the curve, long-term yields rising faster than short-term ones, and that could easily spill over globally, putting more pressure on long-end bonds everywhere.
Which makes things tougher for stocks, too.
Generally, yes. On the flip side, there's speculation the Bank of Japan might revise its inflation forecasts higher soon, maybe could continue hiking rates. If that happens, you could see the yen slowly come back and win back some ground against the dollar.
Interesting. And quickly, Brazil. Political shifts there.
Yeah, a bit of a big tariff standoff politically with an election next year. But the interesting trend noted is a shift away from leftist, populist policymakers towards the right or center-right.
And the market's like that?
Seems so. Brazilian asset prices has actually been performing quite well recently. The view is they just got too cheap to ignore for many investors.
Okay, let's wrap up with a few quick corporate highlights that kind of reflect these bigger trends. Burberry.
Yeah, the luxury brand. Retail sales fell, but less than expected. Seems their turnaround plan, focusing back on classics like the trench coat, it seems to be bearing fruit.
Good for them. Netflix.
Strong numbers. Beat on revenue $11.1 billion and raised their guidance. Market cap crossed $500 billion. Partly helped by the weakness in the dollar, making overseas earnings worth more in dollars.
Right, Saab, the defense company.
They raised their organic revenue forecast for the full year. That's a pretty direct reflection of the strong defense spending in Europe we've been seeing.
Makes sense. And ASML, the chip equipment giant.
A bit of a different story there. Despite getting a boost earlier from U.S. chip policy shifts, now they're facing some demand warnings. It's causing a slight ripple effect in the semiconductor sector, and the stock was a key downside mover.
Okay, so pulling all these threads together, what's the overall market outlook? Still positive despite some wobbles?
Yeah, the general sentiment we're picking up from sources, despite maybe some summer turbulence or feeling a bit overbought here and there, is still basically buy the dips.
buy the dips.
The feeling is we're likely still in a bull run.
Mm.
Could last a year, maybe 18 months, according to some views. The dollar showing some near-term strength, some resilience. And interestingly, bonds are actually looking quite attractive to some people right now.
Because yields are higher.
Exactly, offering better income than they have in quite a while. So bonds are seen as a decent buy.
Okay, so we've really covered a lot of ground today. Central banks, trade wars, fintech disruptions, specific company stories. It's all incredibly interconnected.
It really is a complex picture.
And as we've seen, the global economy is definitely in flux. Policy shifts, new technologies, they're creating both big challenges and some pretty incredible opportunities. So the final thought for you, our listener, to consider. What does this all mean for you? Think about this. If this rapid growth in digital finance, stablecoins, embedded finance, if it genuinely keeps reshaping how money moves, how it's managed globally, just how quickly could that really decentralize financial power? Maybe shift it away from the big traditional banks and institutions we've relied on for centuries.
It's a profound question. The pace of change is accelerating.
It really raises an important question for the future.
Well, thank you for joining us on this deep dive. Until next time, keep digging for those insights.